We're going to go back to Giles Beckford because we just want to update what's happening in both Australia and Asia after the highest ever points crash or fall on Wall Street, not in percentage terms, 87 in the GFC, both bigger, but in points terms off a very high mark, the highest ever Wall Street fall on the Dow Jones on Monday. Asia and Australia, Europe all followed suit. New Zealand was closed, of course, for Waitangi, but Giles is joining us again. Paul Lecomte, who was a fantastic supporter of Checkpoint and a great lover of Dunedin, is just tweeting. Giles, are you there?
I am indeed, John.
I want to read this out to you because praise is not something we deal with at RNZ. We're far too Presbyterian to praise each other's work, and we don't want to get carried away with flannel. But Paul Lecomte says...
We are public broadcasters.
That's right. Yeah, that's right. Paul Lecomte says the RNZ business correspondents have that rare ability, along with the likes of Rod Oram, to explain this insane world of numbers and bell curves and words we can all understand. Vital stuff. He's talking about you, Giles Beckford.
Oh, well, thank you very much. That's much appreciated. That's what we're here for. That's why we do the job that we do. It's why we enjoy the job that we do.
Well, nicely put. What's happening? What's the latest on the markets?
Well, looking to Australia, which has just closed, it's held on to its gains, or most of its gains. It's up about 0.9%. That's 51 points for the ASX 200. In Hong Kong, the Hang Seng Index currently up 1%, and in Tokyo, the Nikkei is currently up around 3%, a little bit more trading there to do. But it looks like that generally the panic is over. The early futures prices that I have seen pointing to London, Europe, and indeed to Wall Street are all modestly higher. There is undoubtedly a degree of nervousness, and jitters are still out there, as you would well expect. But for the time being, it would seem that the precipitous falls that we've seen, and then the just as dramatic rises as we saw on Wall Street, for the time being, they might just be over. But let's not forget that these are markets and anything can happen, especially in a time when a lot of the trading is triggered by what they call algorithmic, which is basically computer trading. You put into your little black box, you say that when the Dow Jones Industrial Average hits 25,000, I want you to sell 10% of my portfolio, and bang, it executes those trades. It says when the Dow Jones is down at 23,000, I want you to buy these particular stocks at this price level, and it goes and does it for you. These things just happen. Humans aren't involved, and of course they can exacerbate the size of the moves and the volatility.
I cannot believe that. So, at 25,000 points, a whole lot of computer selling was just triggered. It's just unbelievable. Bang. Yeah. It's not exactly. I mean, there's lots of people texting in saying this feels like a casino to me. Well, actually, that lack of sophistication kind of supports that thesis, doesn't it?
Indeed, my mum used to call stock markets bingo with a bowler hat. She had a rather quaint Midlands view of share markets, but she wasn't necessarily wrong. I mean, it's speculation. You're chasing the best return that you can get. You're making guesses as to when is the good time to buy, when is the good time to sell. Part of today's selling, for instance, would have been people who have cashed in on stratospheric rises for companies such as A2 Milk, Synlait, Comvita, Pushpay Holdings. Now, if you bought them a year ago on the expectation they were going to rise, you see that the market is turning, you cash in, and in fact, you make a good capital gain, and then you'll wait actually for things to settle, and you'll come in and you'll buy at the lower price, and you'd start the cycle all over again. And this is what share markets are.
I was with Brad Gordon at Hobson's here in Auckland on Shortland Street, and he was saying that the extraordinary thing is that basically the Dow just went up and up and up and up and up, and that we will now perhaps see more volatility. And I think you've been speaking to somebody who was saying the same thing, right?
Indeed. The New Zealand market perhaps hasn't been quite so stratospheric. The Dow Jones up 44% in a little over a year. Our own just up 22% for the top 50. But really the volatility that we've seen is likely to stay. Rob Mercer, who's the head of private wealth research at the broking house Forsyth Barr, thinks that we'll see this for a little time to come.
I think we are definitely going to see a bit of volatility for a few weeks. I don't think we're going to see this volatility just disappear. So I think investors should be patient, stick with quality, and look to come back into the market if they've been fortunate enough to put some away in cash and come out from the buy side. And we're not just talking about New Zealand here, we're also talking about globally. You know, we see better value for investors actually globally than we do in the New Zealand market at current levels.
Well, that's Rob Mercer from Forsyth Barr. He always has a good insight into what's going on. The other factor that perhaps local investors might want to take into account in the coming weeks is that we are just coming into our reporting season. This is where companies, or most of the big companies on the market, will be giving their 6-month or their 12-monthly reports on how their earnings are, how their revenue is going, whether the profits are up or down. We haven't had too many warnings so far of any surprises coming out there, but we can expect some close attention on the likes of Fletcher Building, which of course has been through the wars in the past 6 to 12 months. And we'll also be looking at some of the others, such as A2 Milk, Synlait. We'll also have a look at Fisher & Paykel Healthcare. Those companies which are, should we say, exposed to the real economy, such as the utilities. Pretty boring earnings, but I think people will be wanting to see that's the real measure of the return of the corporate scene in this country. We are dividend rich. It's what drives our share market, and I think investors will be making judgments accordingly. But for the time being, I think we're in for a little bit of a bumpy ride, but perhaps no reason to get too panicked by it.
Giles Beckford, our business editor. People loving your mum's bingo with the bowler hat line. Thanks, Giles. Really appreciate all the stuff you've told us about tonight.